Probably no secret to you by now, but on July 4th of this year, President Trump officially signed the big, beautiful bill into law. This bill is over 870 pages long. There is quite a bit that's in here. And frankly, there's quite a bit in here that doesn't affect every single taxpayer. But in today's video, we want to talk through how this bill will affect pre-retirees and retirees specifically. If you're retired or approaching retirement, there's quite a bit in here that's going to affect you directly. Most of it, I would say, is probably a good thing. There are quite a few things in here, though, that may not be considered so good for pre-retirees. But regardless, when it comes down to it, there are going to be winners and losers from each and every single tax bill. I think you're going to see here that many retirees will come out as winners. Let's get into breaking it down. But before we do, I'm Danny Sinowitz, a CFP professional from Hyperion Financial. Be sure to check out the quiz in the description below to see how the big, beautiful bill is going to affect your tax plan moving forward and seeing how that's going to affect your retirement and ways that you can best prepare to adjust to this bill and any tax laws moving forward. Let's first talk to the wins for some of the seniors that are taking place. This is generally going to be a win for nearly everybody, but the tax brackets that were passed in 2017 have now been made permanent. Now, when we say permanent, I would say a better word is indefinite because tax law can change moving forward, but these brackets were set to expire at the end of 2025. The legislation that was passed now will extend these out indefinitely. That does include things like the standard deduction, the estate tax, and the gift tax exemptions as well. But those even received a bit of an enhancement, which we'll get into. But when it comes to the actual tax brackets themselves, these are now going to be the tax brackets moving forward. So instead of seeing the bump up from the previous brackets that we had, we're going to see that these are going to stay in place for this year, for next year, and again, moving forward. One thing that's going to be nice, though, for everybody across the board, and this will include retirees and pre-retirees, is an additional bump up of the standard deduction. The standard deduction currently is $30,000 for married filing jointly couples and $15,000 for single filers. Single filers would have noticed they just got an increase of $750, and married filing jointly filers have increased that now to $1,500. So again, regardless of your age, you're going to see this bump up in the standard deduction. And don't forget, if you're over the age of 65, you do get an additional standard deduction on top of it. For single filers, it's $2,000, and for married filing jointly filers, it's $1,600 per individual who is over the age of 65. So as a result, the maximum level that you can now get is increased across the board. For single filers, that amount is $17,750, and for married filing jointly filers, that amount is $34,700. But here's where I think the first major win takes place for seniors and for retirees. If you are over the age of 65, you get an additional $6,000 standard deduction on top of the one that we just mentioned. This is per person as well. It's not just per couple. Now, something to note is that this is only temporary. It's only extended out as of right now until 2028. But this is also available whether you take the standard deduction or the itemized deduction. You may remember prior to the Tax Cuts and Jobs Act, a personal exemption that could be claimed. While that isn't the official definition of this, it is essentially serving the same purpose. It's an exemption for individuals who are over the age of 65. If you have two individuals, married couples who are over the age of 65, both individuals can actually claim this, increasing the standard deduction or exemption amount up to $12,000 on top of the standard deduction that you would have. For single filers, it's a $6,000 deduction that you can take advantage of. And again, if you're over the age of 65, you add that to your standard deduction. So for single filers, you can find yourself in position where $23,750 could be utilized if you're over the age of 65 as the standard deduction that you can look to take advantage of. For married filing jointly couples, you're up to about $46,700 that you could take advantage of when it comes to your standard deduction, which is a pretty significant increase compared to the $33,200 that we thought would be the case going into 2025. We'll cover, I think, some of the things that can actually help with this as a result, but immediately what comes to mind is that the tax brackets, which are now going to continue to stay in place, plus this increased standard deduction, is likely going to lead to a lesser amount that is owed for most individuals that are in retirement. For those who would have estate planning tax issues, this is also a win for individuals who find themselves here. For single filer, the estate tax exemption goes up to $30 million per married couple or $15 million per person. This amount is also going to continue to be indexed for inflation. While this amount was set to expire at the end of 2025, along with the tax brackets that we had just mentioned, that's no longer going to be the case. And the enhanced estate tax exemption and the gifts tax exemption is also increased, and again, will be indexed moving forward for inflation. Something else for individuals who are in higher tax states that has long been the topic of discussion, and back in 2017, folks who were negatively affected, is the SALT tax increase. The state and local tax deduction that had previously taken place it did find itself into the final bill, and now the deduction is capped at $40,000. That amount was previously at $10,000, that if you were itemizing your deductions and utilizing the state and local tax deduction that you were able to take advantage of, this is now increased up to $40,000. Now, there are income phase outs if you're over $500,000 of modified adjusted gross income. So again, if you're utilizing itemized deductions and you're over this threshold, you will start to see this deduction phase out. Something else that's important is that this is also a temporary increase. It's set to go back to $10,000 in 2030. If no action is taken, the amount will be able to take advantage of for right now for many taxpayers, but that amount is not going to stay there forever, at least not in its current format. Another big win for seniors or retirees are those who are charitable, but who haven't been able to deduct charitable contributions due to the fact that the standard deduction is so high. Being that the standard deduction only increased, it's all the more reason that many folks may not consider utilizing charitable deductions. However, one thing that has been added, and this was also added back during the COVID year as a result of the CARES Act, is an above the line deduction of up to $1,000 per person or $2,000 per married couple for a charitable contribution. Being that this is something that now can allow for retirees who perhaps aren't utilizing a QCD or a qualified charitable distribution, or who perhaps aren't utilizing, again, the itemized deductions, this is a way for you to take advantage of charitable contributions that you're making as an above the line deduction if you're making charitable contributions. And lastly, something else that could actually be positive, and this may or may not affect certain retirees, but it is something that could affect retirees with car loans or planning to take out a car loan, is the car loan interest deduction. It has been quite some time since car loan interest was considered deductible, and this is now being introduced again, however, with a couple of catches. The first one is that there is an income phase out, $100,000 of modified adjusted gross income for single filers, $200,000 for married filing jointly filers. The other thing that you're going to have to make sure of is that the final assembly was done in the United States of America. So if you have a foreign-owned car or one that was assembled in a foreign country, not finally assembled in the United States, it would not be eligible. Lastly, you can deduct up to $10,000 of car loan interest. It also, though, needs to be at least taken out after December 31st of 2024. So if your car loan didn't originate before then, it would not be eligible. Now, there are several things in here which are not necessarily the most favorable for retirees, specifically pre-retirees. I think the first one that we would want to look at is Social Security, which can actually affect, obviously, pre-retirees or retirees that are collecting on their benefit. While it was a campaign promise of President Trump and many congressional Republicans, there is no change when it comes to the taxation of Social Security. Social Security was not even really mentioned in this bill, and for many folks, there's actually no change whatsoever when it comes to the taxation of your Social Security benefits. So you still use the same provisional income calculation. None of that did change. However, you may find yourself in a position where less of your Social Security may be taxed depending on how your chips fall personally, due to, again, the increase in the standard deduction and the senior enhanced deduction. That could lead to less individuals having to pay tax on the Social Security benefits that they would be receiving, or in theory could lower their overall tax bill. So while it's an indirect way that you could lower your tax, it is not a direct way in which Social Security benefits would be taxed lesser. Another thing that's unfortunate that didn't get changed, at least in the final bill, is HSA contributions for Medicare enrollees. While it was in the original House version of the bill, it did not make it to the final version that was signed by President Trump. So once you are officially Medicare enrolled, you are no longer eligible to contribute to a HSA, which was previously the case and will continue to be the case. So while it was discussed and talked about, it did not make the final version of the bill. And speaking of health insurance, I would say one of the losers of this bill are going to be pre-retirees who are trying to take advantage of Affordable Care Act marketplace coverage and some of the subsidies that have gone along with it when it comes to trying for early retirement. For many retirees who are not yet Medicare eligible, but are no longer working, thus no longer eligible for your employer-sponsored plan, they would look to go to the ACA marketplace. The ACA marketplace, though, is seeing some major changes as a result of the One Big Beautiful Bill. In particular, some of the changes that are taking place are that the premium tax credits are becoming more restrictive. What was known as the enhanced premium tax credits that had taken place after 2021 are no longer going to be in place. They are expiring after 2025. This was something that was passed in the American Rescue Plan of 2021 and further enhanced by the Inflation Reduction Act of 2022. But this bill, much like it can, has taken away some of those benefits that were previously available. One of the other things that's being taken away is the enhanced eligibility. If you're over 400% of the federal poverty line, you are not going to be eligible for this. Where again, previously the American Rescue Plan of 21 and Inflation Reduction Act of 2022 would have expanded the eligibility. Due to the fact that existing subsidies are going to be reduced, you could look to see, depending again on your income situation, that the amount of your premium that you would have to pay could be increased by as much as 100%. There are also going to be some verification requirements which should take place around 2028, which shouldn't necessarily have an effect as much on pre-retirees in this boat, but you do need to make sure that there's a little bit more of administrative work that you could have. Lastly, the one thing that you'll also have to make sure of is that if you're receiving too much of a premium tax credit throughout the year, and at the end of the year, you find out that you would have been eligible for, you're going to have to repay the full amount. There are no more caps on the repayment amount. So you want to make sure that you're planning for this. And as you approach 2026, if you're in early retirement, that you have an understanding of how much the subsidy is that you're going to be eligible for, and that you're prepared to repay any amount if you would not find yourself eligible throughout the year. So what does this mean for seniors, and how is this bill going to affect you? Well, one thing that we do know for sure is that it's going to take effect in 2025. Many of the things that we discussed are taking effect immediately this year, and I think most of the positive effects are taking place this year. There are going to be some negative effects that I think are going to take place in 2026 and moving forward. So again, making sure that you're prepped and prepared to understand what's going to be changing for you and your taxable situation is in your best interest. One thing that I do think, again, is very important for retirees to understand is the fact that some of these deductions that are taking place can really increase the amount of tax planning that you'd be eligible to do. But you also want to be careful to understand that there are still modified adjusted gross income thresholds that if you cross, the $6,000 enhanced standard deduction for seniors, for example, would begin to be phased out. So it's important to make sure that you're planning accordingly for this, that you're planning to make sure that you're minimizing the amount of tax that would be due in a given year, while maximizing the benefit that you can take advantage of. Something else that's important, and to add some urgency to this, is the fact that not all of these changes are going to be in place forever. Yes, it is indefinite where the tax brackets have been now locked in indefinitely. And yes, the standard deduction that has taken place is set to increase moving forward. The enhanced standard deduction that's taking place for seniors is not a permanent thing. The SALT cap increase is another example of something that is not permanent. So if this does affect you and you're able to take advantage of it, you want to make sure to understand that there is an expiration date with some of this. This planning can have a direct impact on many folks, and I do think it's going to lead to lesser tax that would be owed. But making sure that your tax plan is properly in place is of utmost importance. Again, that's why in the link in the description, you'll be able to see a tax quiz. You can fill out some of this information and we'll send you a personalized video to give you a better idea of how you can understand what this bill will do for your tax situation and how you can best plan around it. If you're looking for more in-depth planning, check out HyperionFP.com to get your free assessment for your tax plan along with your investment planning and income planning. Lastly, this bill could affect Roth conversion planning very significantly. If you want to have a better idea of how Roth conversion planning works, check out this video right here and you'll see a step-by-step plan to make sure that your Roth conversion strategy is best set up for you.